we're all looking for data points, signs that the second quarter growth that we saw is somewhat sustainable, but from the data that's been trickling in for July, doesn't look like it.
No, not at all. The second quarter was a mirage. It was a utopia. Yeah, 3.7%. We will not get it. And the reason why the second quarter was very strong is because of the fact that the fourth quarter and the first quarter were very weak. So we just go up and compensating for that. Now we're starting to go back slowly to where we belong. And where we belong is not 3.7, not even 2%, it's 1.5%. That's more or less where we are going.
And what does that mean for the Bank of Canada then?
Well, I think the Bank of Canada will have to think very hard about cutting interest rates. At this point, they are not willing to even discuss it. The Fed is telling us that they are data dependent, but they did cut interest rates. They might cut again over the next few months because of the uncertainty related to trade. And then you're the Bank of Canada, the consumer is not there. Clearly, investment is not there, exports is missing in action, and the only thing all of a sudden that is moving is actually the housing market again. So the housing market has 9 lives. Every time that it's supposed to slow down, something bad happens elsewhere that keeps interest rates low and the party is still going. So do you want to really rely on the housing market to keep the economy going at this point of the game? Probably not, and you don't want the dollar to go relatively high. So you're the Bank of Canada, you will have to start thinking about the possibility of cutting interest rates if the Fed moves again.
But to your point on housing starting to perk up, wouldn't they also be sensitive that cutting rates might further fan those flames?
Exactly, and that's something that the Bank of Canada will like to avoid. However, you have to look at the economy as a whole, and housing is only one part of it. And remember, we have B20 slowing down the activity, namely regulations. So they will have to do the balance and say, okay, maybe housing will go a little bit higher, but given where we are, given where the economy is, given where the Canadian dollar might be going if we are not moving, they will have to make this decision. Our forecast is that they will cut by 25 basis points and we'll call it a day.
Okay, let's go back to the numbers that we got in July and maybe extrapolate and look at it in a broader context, because we've been hearing, that the consumer has been a relative pillar of strength over the past year. But your team actually looked at the data in volume terms and says, actually, it's been no growth, not just for the month of July, but for the past 12 months. I mean, how do we reconcile that with blockbuster jobs growth and wages that have started to really perk up?
Yeah, go figure. The labor market is on fire and consumption is not there. In real terms, as we said, over the last 12 months, nothing to write home about, basically flat. So it's all about prices. And the question is why? And one of the reasons, of course, is confidence. The confidence is not there. The slowing in the housing market had a negative wealth effect. Basically, when the housing market is slowing, consumers are not spending the way they do when the housing market is strong. And of course, we're talking about the nature of employment. Not all jobs were created equal. And the quality of employment, as we have indicated in the past, started to slow down over the past year, reflecting lower paying jobs. And also, of course, wages are not rising to the same extent that they are rising in the US. So we have an income problem in this country, and we are seeing this income growth problem happening now, and therefore limiting the ability of the consumer to save the day.
And a debt problem on top of that.
Yes, the debt, of course, is always there, and people are struggling. I will not suggest that the debt payment is the #1 factor impacting the consumer. I think it's more wage growth and the quality of employment, but clearly in the background, you have the debt situation, which is limiting the ability of the consumer to spend.
The conversation around the election has taken a very different turn from being about pocketbook issues, but we were talking to a pollster about an hour ago, and one of the questions they ask people is, do you feel better off today than you did 4 years ago? And he says his polling, except for Quebec, shows that most people feel worse off 4 years later. Is that netting out in the data? Again, trying to reconcile that with unemployment at these low levels.
Exactly, and that's something that we have to look at, because we are looking at the debt level. Of course, it has been rising and people are struggling a little bit financing it. We know that in the suburbs, the debt to income ratio even rising faster. We have a situation in which interest rates have been, rising a little bit before starting to stabilize. That's something that impacted the psyche of many consumers. The savings rate is relatively low, not giving you some, freedom, if you wish, to spend when you need. And of course, the quality of employment is not there. So we're creating a lot of jobs, but those jobs are not generating a lot of income and other factors. So I'm not extremely surprised with this answer.
Lastly, I just want to ask and get an updated view from CIBC at least on your recession forecast. If you're looking at such a deceleration in growth in the third quarter, where are you with respect to forecasting the next recession and when that might be imminent?
Well, I think that we have to put it in perspective because, as we all know, the potential growth of the economy, the speed limit of the economy is going down. And the demographic story is the number one factor. If potential growth, the speed limit was 2.5%, maybe now it's 1.5%. The number one factor, again, the aging population. And Trump can do many things, but Trump cannot make America young again, yeah? They cannot do that, and therefore the demographic story is with us. So when you fly so low, potentially just 1.5%, that's your potential growth. When you fly so low, accident can happen, and you can go to negative growth like that. And that's something that can happen tomorrow. So we will see more people talking about a recession because GDP growth will be close to zero because it's starting from a very low level. I think we have to look beyond that. So we will see 2020, a difficult year. Our call is no recession, but at some point in 2020, it will feel like a recession.